Hello, this is Dale. In this video, I'm going to be discussing credit spreads and how you can master them and use them to profit on a consistent basis and generate monthly income. Again, my name is Dale Brethauer. I've been a trader for 35 plus years, hedge fund manager, guest speaker at a number of platforms. I've written 3 financial books, and I am the founder of what I believe the very best educational stock and option website available today. That is www.optionsinfinity.com. What I'm going to be going over in this video is the advantages of using credit spreads, how time value decay of options works in our advantage, what are bull puts, bear calls, and iron condors, how you put them on, how money is made with credit spreads, 3 ways. Then I'm going to go over a couple actual trades that were bull puts that we put on and took off in April of 2020. Then we'll take a quick look at how I've been doing for 2019 and all the way up to current. Talk a little bit about generating income and financial freedom. And then at the very end, I'm going to take you on a field trip over to my website and discuss what we've got available there and an opportunity for you to become part of our community. There are many advantages of vertical credit spreads. The first one is you get great returns coupled with a high probability, and this yields a monthly income on a very consistent basis. We are sellers of premium, so time is in our favor. One of the problems with buying options directly, either calls or puts, is it has to go in that direction. If you have a call, you want it to go, the price to go up. It has to do that. Not only does it have to do that, but it has to do it quickly before time expires. If you have a put, you're looking for the price to go down, and it has to go down quickly before it expires. With credit spreads, we are sellers of premium. So time is in our favor. You don't have to constantly watch the market or chart hawk. It's a low anxiety form of trading, and there is protection against loss. In this chart, what I'm showing you is the rapid decay of option premium, especially in the last 30 days. What we're going to be doing is selling out of the money options. Out of the money options only have intrinsic value or time value associated with them. As you get closer to expiration, that value diminishes quickly. And you can see in the last 30 days, it drops off very, very rapidly. That's to our advantage because we are sellers of the options. There's protection against the loss. Think of a vertical credit spread as simply selling one and then buying one further out of money. You make money on the one you sell. And then the potential loss can be, if you sell that and you don't protect yourself, the potential loss can be unlimited. That's what they call naked selling. And a lot of people are attracted to that because they look at the premium and it's so high, they say, well, why bother with protection? Why not just sell that directly? Well, actually, because it's so risky, the floor traders will require a higher margin. And when you look at return on margin, credit spreads actually are better than selling naked, and you've got the protection you need against the losses that could occur on a catastrophic basis. The difference between the two strikes is the maximum loss, and that is also the margin that would be required. Now let's take a look at a bear call spread. With a bear call spread, what we are doing is we are selling an option out of the money, and then we're buying one further out of the money for protection. This is a bearish strategy, therefore the name bear call. We're selling calls. We're thinking that the price is going to be going down. It's a type of option strategy used when a decline in price of the underlying asset is expected. Okay, in this example with Amazon, and this was July 26th of 2019, Amazon was sitting at right around 1945. So what we wanted to do is we went in and we sold an option that was out of the money. We went to the 20 September 280 call. There's the 280 call. Excuse me, the 2080 call. And we got $18.24 credit for that. The same time we did that, we bought one further out of the money, this one right here. And that was the 20 September for the same time period. And that was 2090. And we bought that for $16.12. The difference between these two is called the net credit. Okay, if it goes all the way to expiration and does not go above here, you collect the total amount for the $2.12. With my trading strategy, I never do that. I usually get out when I've got about 50 to 75% of what I can get if I reach Fibonacci's or some other indicator that tells me I need to get out and take some profit. This is a risk profile of the bear call. And you'll notice that this is the red is what it will be on expiration. And the white line is what it is today. On expiration, you can see that as long as it's below this number right here and stays below there, you can gain the maximum amount of credit that you take in. Then the risk is limited. The risk is limited down here because we have bought the option to protect us out here. So this is the max gain, this is the max loss. But as the trading goes on, we're following this white line to determine at what point in time do we want to go ahead and take our profits, at what point in time do we want to go out and exit the trade. Now, a bull put spread is a type of strategy that's used when investors expect a rise in the price. Thus, the operative word here is bull. This is a bullish strategy. We are selling puts. Okay, you can see right here in this example on Amazon on November 27th of 2019, Amazon was sitting at 1820. So what we did is we sold a 20 December 1750 put, which was out of the money, for $12.36. At the same time, we bought one further out of the money, 1740, for $10.50, bringing in a net credit of $1.82. Now, the risk profile for a bull put looks just the opposite from a bear call. However, it basically is showing you the same thing. This is the total amount that you could make. This is the total amount that you could lose. But the red line again is at expiration. So let's say that we're sitting right at 1340 at expiration. You're going to gain the total amount. Okay, and that's how you read this chart. Now, an iron condor is simply putting the two together. You put a bear call spread plus a bull put spread together. An iron condor is an advanced option trading strategy that utilizes the bull put and the bear call with the same expiration. The number of call spreads will be equal to the number of put spreads. You can see that this is the bull put risk profile. This is the bear call risk profile. This is the maximum amount you can make. This is the maximum loss that can occur. Now, an example of an iron condor is if we went in and did one on the RUT and did a bull put for September, selling the 1080 and then buying one further out of the money for a net credit of 85 cents. At the same time, we are going to sell a September call at 1160 and then buy one of those further out of the money for a net credit of $1. So for an iron condor, you're going to take in the credit for both sides. The advantage of an iron condor is if you think that the price is going to stay relatively in a channel for a while, you can collect both sides. If you feel if you feel very bullish about the price, what you want to do is a bull put. If you feel very bearish about the price, you want to do a bear call. If you feel it's going to channel for a while, you want to do an iron condor. Now, here's the beauty of vertical credit spreads. Let's say we're starting right here. This is our entry point, and what we're looking for is on a bear call. You can see at this point it drops some, and at this point in time you would have made 67%. Well, then the price advanced up, and at this point you would have been down 21%. But then it did drop, and you could exit all the way down here at 100%. So the beauty of the credit spread is that if you have a bull put and you think it's bullish and the price goes up, you are a winner. If the price goes sideways, you are a winner. If the price comes down, but not all the way down to where you had the out of the money option that you sold, you are a winner. So there are three ways to win. It's less anxiety. You don't have to be exactly correct. It's more conservative. And like I said, there's three ways to win. I mean, here you thought that it was going to go down, but then the price came back up, and that's okay. But then it finally went down, and you did quite well on this bear call. Here's one on a bull put where we got in down here, and this first point we're looking at, it was looking good. You were up 38%. But then as prices go, they don't go just straight up and straight down. They go sawtooth, and this one went up and then it came back down. But it actually came back down lower than the point that when we got in, but you were still making money. And you were able to hold on to that because we had a bull put that was way down here. And then finally we got out at 84%, way up here. Three ways to make money with a credit spread: a bull put and a bear call. Now let me show you two profitable trades we just recently got out. And the first one was a bull put spread on Costco. And let me show you what the chart looks like. What I do is first of all, I have the regression channel on here. The regression channel helps me because 50% of all prices are calculated. The regression line, 50% of all prices are below, 50% of all prices are above. So you get this regression line. And then the green line is plus or minus 1 standard deviation. The gold line is plus or minus 2. Statistically, 95% of all prices will be contained within the plus or minus 2 standard deviation. So when it's down in this region, I look at this as being oversold, and I'm looking for it to revert back to the mean. What I have here is a measured move. A measured move, this is the low, it comes back up, it comes back down, but makes a higher low and then makes a higher high. Once you have a measured move, you can put on Fibonacci's and you can see it blew right through the 127, the 161, and went all the way to the 261 at the +2 of the regression channel. This is a great time to take profits. All this is described in great detail in a video that I'm going to have a link for you at the end of this video. So we got into Costco on April 6th of this year at 200. It was at 293. The bull put was we sold the 17 July for 255 put, and we got $6.80. That's this one right here. Then we bought the 245 that's further out of the money. This one right here for a net credit of $2. Now notice how far away we are. This is a very conservative bull put. Okay. If it goes up, you're in good shape. If it goes sideways, you're in good shape. If it comes down a little bit, you're in good shape. This one actually went straight on up. And 10 days later, we got out by buying back the option that we sold, the 17 July 255 for $4.08, and then selling the one that we had bought for $3.03 for a net debit of $1.05. We brought in $2, we got out at $1.05, we made 95%, 95 cents profit, or every contract is 100 shares, so it's 95 cents times 100, or $95 on one contract. This is about 50% profit on the credit. This is for one contract, okay? For 10 contracts, you're looking at a $950 profit. For 50, you're looking at $4,750 profit. This is a very lucrative trade, and this can bring in consistent monthly incomes. Now, this was a profitable trade. I have to tell you that past performance is no guarantee of future results. But Options Infinity has about 75% profitable trades year after year. This was a trade we made on the SPX, and the SPX was down below the -1 on the regression channel. It looked like it made a measured move here. Notice it comes up, comes back down. It has a higher low, makes a higher high, time to get in. There's the Fibonacci's, and we did get out because it had a nice advance, and I felt it was time to take profits. We got in on April 7th when the SPX was at 27.15. We sold the May 15 out of the money, 2,400 put for $66.40. Then we bought one back that was $23.90. That's this one right down here for $64.50 for a net credit of $1.90. Now, this is where people sometimes get greedy and say, wow, if I think this is the price is going to go up, why not just take this and sell it and take all that profit? The problem comes every once in a while, this trade's going to go against you and you're going to have unlimited risk. And that's not the way to trade. We got out again 10 days later. When we bought this back, we bought the 2,400 and sold the 2,300 for a net debit of 85 cents. Net credit was $1.90. We got out with 85 cents for $1.05 profit, or $105 for one contract, $1,050 for 10, $5,250 for 5 contracts. And this is about 65% profit on the credit that could be taken in. I want to just go over quickly some highlights from a book that was written by Dr.Van Tharp. Dr. Van Tharp helped me quite a bit to learn the psychology of trading and realize that one of the biggest things you have going against you is your ego. You got to check your ego at the door when you're trading. Credit spreads are a wonderful thing because you can win three ways. The anxiety is not as high. But in his book, Generating Income and Financial Freedom, he says that financial freedom is really a new way to think about money. Most people think they win the money game by having the most money and most toys. Financial freedom means that your money works for you and it makes more money than you need to meet your monthly expenses. That doesn't mean you won't spend hundreds or even thousands of hours building the foundation for this financial freedom, but it does mean that financial freedom is possible once you lay the groundwork. And this kind of flies in the face of what a lot of financial advisors tell you. This is saying that large amounts are not necessary to have in the bank. What you want is consistent cash flow from the money you have from credit spreads on a monthly basis. In this chart, what I'm showing you is the returns on margin of my account for 2019 up till the current on 2020. You'll see that this is a very positive equity curve. There are some losses, there are some losing streaks. You just stay with the strategy. This recent drop was because of the coronavirus scare. This dropped so quickly, it was hard to get out of some of the trades. However, we have rebounded nicely, and I'm expecting a positive 2020 as we go further. What I'd like to do now is to go over to my website and just describe what I've got there and give you an opportunity to join our community. This is our website, www.optionsinfinity.com. We've been in business for 10 years. And in those 10 years, we've been averaging about 75% winning trades. If you scroll down on this home page, you'll see that I've got a free PDF file here on my 3 principal method for trading. This is how to get in, how to get out, how to utilize this strategy, this methodology for stocks, for options, for Forex. We do specialize in credit spreads. You can either view this or download this just by clicking on the button. Then if you scroll down a little bit, you can click on this this video right here to view how a mentor speeds up your trading success. I'd like you to become a member of our community. One of the things that I do is when I see a trade and what I am doing, I will send you a text and an email alert telling you exactly what I'm doing, how I'm getting in, which ones I'm buying, what strike prices I'm buying, which ones I'm selling. And then when I'm ready to exit that, I'll also be sending out a text and email alert. So this is kind of like looking over a professional shoulder and watching me trade. We also get together once a week as a community, and that's at noon Eastern time on Tuesday. This is taught by myself. We usually have a little lesson. Then we go over our current trades and what I see in the next coming up in the next week. And there's plenty of time for the mentees to ask questions and make sure that they're fully grounded. You're also going to receive the entire masterclass suite, which shows you exactly how I trade Forex, weekly options, monthly options, stocks. What I'd like you to do is on the right-hand side, you'll see my subscribe button. If you hit there, you can subscribe to my YouTube channel. I have over 20 educational videos that you can view. I also, on the right-hand side, you'll see a thumbnail of a link that will take you directly to part 1 of my 3 principle trading strategy, and you can learn exactly how I do this for stocks and options, ETFs, and Forex. I'd love you to be a part of the community, and I hope to see you in the meeting room. Bye-bye now.